Good morning, and welcome to the third webinar in the NIC Leadership Huddle series. This morning's panel of prominent real estate research directors will address market trends in the economic outlook. I'm Chuck Perry, NIC's Chief Operating Officer, and I'll be facilitating questions for this morning's panelists. Before we begin our discussion, let's review the webinar's technology logistics. You have joined the webinar using either your computer's speaker system or your telephone based on your audio access during your most recent GoToWebinar session. You can adjust your audio access to this morning's webinar through either your computer speakers or your telephone using the settings in the audio pane, which is located on the top of the control panel on the right side of your computer screen. We welcome your questions for our panelists during today's webinar. To submit a question, type your question in the questions panel located within the same control panel on the right side of your computer. You may submit questions at any time during the webinar, and select incoming questions will be answered following the panelists' discussion. For those questions not answered during the webinar, we will strive to follow up with individual responses following the conclusion of the webinar. For those of you on Twitter, our hashtag for this webinar is #NICLeadershipHuddle. Now that we've addressed the webinar technology logistics, please welcome my associate Beth Mace, who will begin our discussion.
Great, thank you, Chuck. And welcome everyone, and thank you for joining the webinar today. I must admit, I'm very excited about moderating today's panel. We had the pleasure and the honor of being joined by three of the most respected and brilliant minds in commercial real estate industry. I will let each of them introduce themselves, but let me start by saying that I work with Mike Acton for more than 25 years, first at DRI McGraw-Hill, and then at AEW Capital Management for 17 years. We collaborated on research over the years, and many Fridays do we sit in front of the Bloomberg terminal waiting to get the first report from the BLS on the employment numbers for that month. I've known and been friends with Mary Ludgin for 20 years, first getting to know each other at NACREIF meetings across the country. And I've also known Calvin for a number of years in his research role at NAREIT. So I'm thrilled that they are collectively joining us today for the third NIC Leadership Huddle. And without further ado, Mary, can you introduce yourself? Let our audience know a little bit about your background.
Good morning, everyone. Thank you so much, Beth, for including me in this webinar. This is my fourth recession. And for as much as aging has its challenges, one of the good things is that I bring to this downturn some insights, as do, of course, anyone else on this panel. We bring insights that we learned across the three prior recessions. The 90-91 downturn got me an office. That was fabulous, over the bodies of the fallen masters of the universe. This is a time for us, perhaps I'll review what's his name's book. Anyway, one thing I would note is that one of the things that we extracted as a firm from prior recessions was to bring specialty property types into our portfolios for our clients. Our clients are institutional investors globally, pension funds, college endowments, foundations, and sovereign wealth funds. And many of them simply had office, industrial, retail, and apartments in their portfolios prior to the global financial crisis. And what that taught us was that those were sectors that perhaps were a little too macro driven, and we should include in our portfolios sectors like seniors housing that have demand elements that exist across the cycle. So that's informed our portfolio construction. Our first seniors housing investment was by accident. We bought a mall in San Francisco in the late 80s and got a senior housing building along with it, but didn't really go into the sector meaningfully until the early 2000s. I'll stop there and say thanks so much for joining us this morning, and I look forward to the conversation.
Great, thank you, Mary. Mike, can you introduce yourself to the audience?
Yeah, sure thing. There I am. Hey, good morning, everyone. This is Mike Acton. I'm the head of research for AEW. As Beth said, I've been at AEW a long time. It's actually 30 years this month. So seen a lot of things, much like Mary. On behalf of all my colleagues at AEW, I hope this webinar today finds you well, your family, your employees, your residents. These are really trying times, and we're all trying to find our way through it. At AEW, I serve on the firm's management committee. investment committee, risk management committee. We got a lot of committees. And much like Mary and Heitman, we've been investing in seniors housing. We started in the mid-90s in our opportunity funds, expanded around 2000 into some separate accounts. And then right around the time of the GFC, we started our very first senior housing fund, and we're now on the fourth fund in that series. So I think I'll stop there and turn
Great.
back to Beth.
Thank you, Mike. Calvin, can you introduce yourself, please?
Yes, good morning. Hi, I'm Calvin Schnorr, Senior Economist at NAREIT. NAREIT's trade association for all types of REITs, including senior housing, as well as all the other sectors. And I've been here for about 9 years. Spent the first decade of my career after grad school at the Federal Reserve Board, where I was first huddling over the Bloomberg terminal looking for the employment report. Spent a decade there under Chairman Greenspan, and then I was on Wall Street with JP Morgan for a number of years, and I actually spent the mortgage crisis at Freddie Mac, which was a challenging environment. At NAREIT, I spent about as much time tracking the overall economy and general commercial markets, not even just focusing on REITs or the senior housing. So I still huddle over the employment report on that first Friday morning. I appreciate Beth for inviting me here. I've known Beth for many years. My first research paper on seniors housing was, I think, about 6 or 7 years ago, and I had been working with a lot of government data sets, and I was trying to figure out what was going on. When I first met with Beth, and she actually said, yes, that is going on, what's going on, it was a real relief. So I've worked much more closely with her for the years since then, and I'm looking forward to talking today about how this economy is going to be affecting our industry.
Great, thank you. And if we can go to page 2 on the agenda. So we're going to set this up. We just went through introductions. I'm going to briefly talk about the results from our executive survey insights that was just released this morning. Then we're going to really break the discussion up into 3 pieces: a macroeconomic viewpoint, capital markets, transactions, pricing observations, seniors housing assessments, and then some summary comments. And if we have time, down to a lightning round. So if we can go over to slide 8. This is the results from wave 3 of our executive survey insights. Nikki, can you move to slide 8? The survey was conducted between April 13th and April 19th. We had about 105 respondents to this survey, and one of the questions we asked was a change in occupancy by care segment being independent living, assisted living, memory care, or nursing care. And we would expect, due to the COVID, that you're going to start to see a decrease in the occupancy rates. And in fact, that's what we have seen. And the most significant decrease has occurred in nursing care, where you'll see an 84% of the respondents are identifying declines in occupancy rate in the period ending April 19th. The prior 2 surveys also indicated that nursing care had the greatest change in occupancy being reported, but there were lower numbers. In wave 2, it was 70% as opposed to 84%. And in wave 1, it was 50%. So we can see as time goes on, there's an increased number of respondents reporting declines in nursing care. Following nursing care, the highest decline that we've seen has been in assisted living at 65%. More details for this can be found on our website, www.nic.org, and you can look under the blog posting, or you can look under the resource page. The next slide, slide 9, is looking at another question that we've been asking on our survey, and that's looking at what's the reason for deceleration in move-ins in the past 30 days. And the deceleration in move-ins for nursing care, again, we saw the greatest number of respondents reporting decelerations in wave 3, 87%, assisted living 74%, and independent living 71%. And the reasons for that largely were related to a slowdown in leads, conversions, and sales. And this is particularly prominent in skilled nursing, where we're finding that there are fewer hospital referrals and fewer elective surgery rehab needs. And as a result of that, the move-in rates for skilled nursing are starting to decelerate pretty significantly. And if we can go back to slide 2 for the agenda. With that, I'm going to launch into a question, and we're going to do this in a format. We're going to do a little bit of a round robin, and I'll ask each of the participants on the panel today what they think, and then we'll flow into individual questions for each person. So back on slide 2, for the first question in the round robin, it's going to be related to macroeconomic things. So Mary, starting with you, where do you think the economy will be in 1 year, and how will we get there?
Let me first say thank you so much for not saying in 6 months, because there are going to be many chapters to this recovery. What we don't yet know is when the vaccine will be available, if there will be a vaccine. We can't all get tested yet. That's a hindrance that's going to affect the near-term reopening. What we'll know a year from now is how the Cubs are shaping up. We should have had opening day by then. Amen. Baseball will be back. And I use baseball as a metaphor here for some level of normalcy will have returned. I have a feeling we're all going to still have masks. We're going to mimic the Asian population that carried masks with them long before this as a result of SARS. So that will be an element of daily life. The economy will have emerged from recession by a year from now. It will not be a V in the traditional sense of a word, maybe a Roman V, maybe a pretty wide out V. There will be lingering issues that relate to the massive unemployment that is created by the loss of small business, even with massive government subsidies and stimulus, I should say. Even with that, there are going to be businesses that will never reopen. They will, in the long run, be used again, some of them, but in places like the retail sector, we should anticipate structural vacancy at levels we have never before seen. With that, I'll stop, Beth.
Okay. Mike, what do you view in terms of where the economy is going to be in 1 year, and how are we going to get there?
Well, I think Mary's right on point there. This is very path dependent upon what happens with the public health crisis and the response to it. The vaccine's part of the story. Part of the story is figuring out how many people have actually already been exposed to it. There was a very interesting exercise done up here in Massachusetts last weekend. I believe it was in the town of Chelsea, where they, some researchers from Mass General tested a group of people sort of chosen at random and found much higher exposure rate than had previously been believed in the general population. So if that were to be discovered and turned out to be true, you might have more normalization sooner, things like that. You know, bigger picture events like this, these exogenous sort of events, these black swan events, they do tend in history to accelerate things that were already happening in the economy. So the changes that we see happening in retail, as an example, that's been playing out for a while. This has accelerated it very quickly. It's going to be really hard to go back to exactly what was in place before. I don't think anyone really expects that. We're going to all have to figure out how many of us are actually going to be going back to our offices. How often will we do that? How often will we choose to continue to work at home? There's all kinds of implications of that for how our offices will be configured. If people are going to work at home, what type of things are they going to want to have in their house that they don't have today? You know, the implications get pretty broad as you go further and further out in the future, until such time as nobody's really worried about this again. So it's probably sort of 2 steps forward, 1 step back over the next year. I do agree that we will get something that we're going to call normal or new normal, but I don't think it's going to look much like where we were on January 1. At the very least, it seems like we're going to have a much more robust public health system in the future, because this won't be the last one of these things that comes around, I'm sure. But there's as many unknowns today still as there are knowns. So a lot of this is conjecture, and people really do want to know: is it a V? Is it a U? I've heard people talking about the Nike swish symbol and things like that. I just don't think we know enough right now to know exactly what path the economy will take until we have some idea what path the public health success is going to be.
Great, thanks. Calvin, what's your view on the economy and where we're heading?
You know, my advantage of going third is that you've already said all of the top line points I would have started with, and I agree with everything that Mike and Mary said. What I'm looking at is there's a distinction between 3 types of impact. What I call the front wave, the first round, are things like the hotels, the travel, the airlines, the retail that is shutting down because of the direct concern about COVID. The second wave would be the upstream sectors that are counting on receipts from the front line. So this would be the lenders. Well, it would be employees who may have been fired because or laid off because the business is shut down, or the banks that may all of a sudden get delinquencies. And from our perspective in real estate, the property owners who may not be getting rent payments, or those who may not getting mortgage payments. But there's also a third round, which is just the general macro effects of a weaker consumer, greater business costs, and I'm particularly concerned about the costs of bankruptcy. That if a firm is shut down for a while but remains intact, has the lending support to get them through, and has some hope of a business model later on in the year, they can bear those costs. They can swallow those costs. But the bankruptcy costs could be a much bigger drag on the economy. Now, what are we going to look like? The shape of the recovery. Keep in mind, it's not affecting all parts of the economy evenly. And there are going to be some things like the travel, the restaurants, the theaters, and so on, that may not come back at all. The rest of the economy was in reasonably good shape before this crisis hit, and that's going to help lift the economy. But there's going to be different patterns of spending and patterns of activity. I would just close by saying, is there any chance for some optimism? Well, I was working on Wall Street on September 11th, and I did not think that the world would ever be able to function well again after that. I was working at Freddie Mac during the mortgage crisis, and I had a similar feeling. We got through each of those. It's going to take some time. It really depends on the progress on the health front, but then we will get there.
Great. Kellen, let's stick with you for a minute. And you've been tracking pretty carefully fiscal and monetary policies that have been implemented. Can you talk about that a little bit? And maybe we want to use a couple of your slides.
Sure, I would. I've got some slides that have more detail than anyone is going to want to read. You can actually contact me at NAREIT, cschnor@nareit.com, if you want more details. I'm happy to discuss it. I would break down. If we can advance these slides somewhere. I've got a slide.
I think to slide 12.
I would say there are three broad categories. There's spending, there's lending, and there's stabilization. The spending, what we've seen Congress pass is the PPP program, the different support where they're sending a $1,200 check to every household, the spending for all the different sectors. That's direct support trying to staunch the bleeding that is in some of these sectors. The lending are the programs that the Federal Reserve has put in, including the Main Street lending program and the others that are trying to provide financing. And then finally, the stabilization, where the Federal Reserve is putting in the quantitative ease programs that they had developed just over a decade ago. Now, a couple of quick comments on the overall set of programs here. First is it is hitting on a lot of fronts, and that's needed. Second, they came into place very quickly, also very necessary. And third, they're big. The Fed in particular was able to put into place programs that took them 3 or 4 months to develop in 2008, 2009. They put them all in 10 days. Why? They had the design. It had been tested through a crisis. They knew it worked, and they knew that they wanted to do it. One final point here. Many people ask, is the Fed out of ammunition? Chairman Powell was asked that on TV a couple of weeks ago. He clearly said, no, we are not out of ammunition. And actually, they've got the right ammunition. In a normal business cycle, where businesses are trying to decide if it's worth investing in something given the cost now, the interest rate really matters for that calculation. This is different. Firms have had a complete shut off of cash flow. Interest rates don't matter because they're already at zero, but you've got lending programs saying, we can tide you over to avoid those bankruptcy costs I talked about earlier. This is the right type of policy. So there are a lot of policies. We need them because this is a major crisis, and we're going to need all of these policies to get through it.
Great, thank you, Calvin. So I'm going to switch gears a little bit. If we can go back to slide 2 again for the agenda. Starting with you, Mike, what are you telling your investment committees and clients about the path forward, and how active is the market today?
Well, I mean, the market's not particularly active. It sort of pencils down across most of the business today. for a lot of simple reasons. You know, it's hard to underwrite a property if you can't actually visit it, right? So there's that aspect of it. But transaction volume in general has slowed pretty significantly. What are we telling the investment committee? Well, we're telling them really to think about this as you would expect. Think about it in terms of scenarios, sort of a best case, a middle case, and a worst case. And both as a business and as in terms of investments, we really have to think about all three of those scenarios, or even more scenarios. So how much is NOI going to get impacted? That's probably the first thing to be thinking about today. A lot of people have questions about valuation. I think right now, most of the industry's at the point where they're really only comfortable speculating on what the NOI impact, at least near term, will be. But that also brings up the other questions of, will people change capital market assumptions? What I mean by that, are people going to rethink what the required yield's going to be for their properties, the cap rate? Are people going to change their discount rate on investments? I just don't think we know just yet. The Fed obviously has taken interest rates to zero or pretty close to zero. That's probably necessary. But capital markets really only work when there's a price of capital. And for a very long time now, we've had a very distorted price of capital, economy-wide, globally even. And you have to think that when the price of capital is distorted, you get a lot of misallocation of capital. So there's going to be a lot of opportunities that are going to show up going forward from here. You can't have it a 10 or 11-year expansion without a lot of people being drawn into industries and investment activities that maybe they really shouldn't be in. So I think there's very quickly going to be a revelation of weak hands versus strong hands. So we're just trying to get everybody trying to think about in scenarios, be ready to act when things start to present themselves. Be patient, because in the financial crisis, I think we saw that it took much longer for the pain to really shake out those opportunities. But they're very much going to come, and so just stay ready.
So, Mike, what are some of the lessons that you did learn from 2008 and 2009, the experience, and how are you applying that to the situation today?
Well, we learned a lot of lessons. I think I think the most important lessons were really the sort of triage in stages. Get on top of things very quickly in terms of debt maturities, covenants, things like that. Keep open up dialogue and communication lines with your lenders, with your tenants, with your joint venture partners, with your property managers, all of that stuff. Keep your team intact. Keep them ready, because you're going to need them. Things get harder as you start working through events like this. So you're going to need more hands, not fewer hands. That's an important lesson. But in terms of actual investment structure and risks and so on, I think the overwhelming thing we learned from the financial crisis, and we've been applying this pretty rigorously over the last decade, is to make sure that your capital structure on your asset very much matches the investment that you're doing in the environment you find yourself in. So in other words, if you're trying to do some sort of value add strategy, some sort of turning a property around, maybe physically changing it, something like that, you need a capital structure that has flexibility in it, that's going to allow you to do that over an elongated period relative to what you originally underwrote. So if you thought it was 3 years to turn a property around, you need flexibility in your capital structure to maybe have that take 5 years if the economy turns on you, which obviously it is right now. So I think that's probably the most important lesson we learned. You don't want your lender dictating the terms to you. You want the flexibility to extend and do what you need to do.
Okay. Mary, same question over to you. What are you telling your investment committees and your clients about the path forward, and what advice are you providing?
It's so interesting. The mood of investment committee is so different from this point in the aftermath of Lehman failing. We were in recession before Lehman went down in September of 2008, but Lehman really brought it to the fore. And then there was a lot of looking around for who caused this? Why didn't we call it? And other distractions. This time, I agree utterly with what Mike has said. There's a lot of blocking and tackling that we've learned how to do, the connections to the lenders among them. What's new this time is the connection to the tenants all of them needing context immediately, as there have been some unexpected collection dips in various property types. The law firms in office buildings that have chosen not to pay and sent very nice notes suggesting that if we'd like the rent, we can sue them, right? That's not exactly the opening gambit we would like. But so on the property management aspect, asset management aspect of this, that we certainly know some things to do. Other things that we know about that were reflected in our various investments, in our value-added realm, there we've long wanted to have a mix of properties that are throwing off income, no matter where they are in their execution, as well as those that are in the execution stage where the income is and the value is going to be created later, knowing that their recessions always interrupt executions. So luckily our core plus and our value strategies have a lot of income in place. Other things we're talking to them about are topics they're also raising with us, which is what the last go round taught us was it brought debt as an investment vehicle from stodgy to sexy, let's say, and debt will be one of the first areas to see capital raised and deployed in this environment. You can already see it in the magazine, the rags that are going around. REITs, Calvin, we all know this, REITs will be among the first to recover, and REITs were meaningful elements in bracketing the extent to which cap rates rose during the aftermath of the tech downturn in 2001. They'll have, in all likelihood, they'll continue to see the rebound that was evident recently, and they'll be active capital market participants. One final comment. We know that one of the reasons that there are no transactions now, nor will there be meaningful numbers for a while, will relate to the bid-ask spread. Hard to know what valuations are. Mike mentioned it appropriately. We don't know what valuation metrics will be, what they should be. We don't know what cash flows are. And therefore, we're going to have buyers that have one view of value and sellers that have another view. You're going to see a lot of structured transactions come out of this, where those would-be sellers need capital, but they don't want to sell at the prices we're willing to buy. So we're going to be able to create structures to bridge over that.
Great. Thank you, Mary. Calvin, so that was a good segue over to you in terms of what's going on in the public markets and the relationship between public and private pricing, and do the public markets lead? What's going on? What's your view on that?
Well, the public markets certainly lead in one sense in that we get a price every day. And the private markets have quite a bit of delay. Sometimes if it's appraisal, maybe a year or more. If it's a transaction, it takes quite a while to see what's going on with those transactions. Many people make the mistake of saying that the public markets are a forecast of what's going to go on in the private market. Now, having been a forecaster for 30 years, there's a difference between a signal and a forecast. A forecast says, we think this is where it's going to go over the next year or 2 years. It's not just direction, but also some specificity. Whereas a signal is saying, oh, look, this is falling, maybe you should be concerned. Sometimes a signal is just a warning that's not realized, and we do see that. And I would say that right now, the public markets clearly send a signal that we know that conditions are going to be weaker, not just for senior housing, not just for real estate, for the entire economy. But if you look at what happened over the past 5 to 6 weeks, you saw public markets, for seniors housing, for all REITs, for the stock market as general, fell very sharply because people didn't know how to price these risks. Mary and Mike were just talking about these risks, and there's just so much uncertainty that we've never faced before. But then they pulled back quite a bit, in part because they saw such strong policy support in terms of the stimulus program and the Federal Reserve, and it's back up a bit. The range of uncertainty is still very wide. Quite clearly, the private prices are going to be down, whether they settle at where we were several weeks ago, where we are right now, or where we end up in the public market in a couple of weeks, we're just going to have to wait and see. The final point on this is the difference between public markets and private markets is you've had a lot of trading volume in the public markets. You've had very little. Mike said that there's very few transactions, which makes sense when neither the buyer nor the seller can agree. That makes the private market less informative about the current state of the market until this uncertainty is resolved.
Okay, so Mike, back to you. On one of the slides, I think it's slide 23, you look at the differences between private and public market pricing. Can you talk to us a little bit about that relationship that you've been tracking?
Yeah, sure. And this is something that's been sort of known for a long time. If you go put page 23 up if you can there, but if not, I'll speak to it anyway. This is a very simple chart. It's showing the implied cap rate from the REIT universe from Green Street. It's showing the BBB corporate bond yield, and it's also showing the average cap rate from NCREIF. And just to be clear, the blue line is just the 4 major property types from Green Street. And you can see back in the financial crisis when credit spreads blew out, the BBB yield went way high. The implied cap rate on the REIT market moved step by step with it. In other words, the REITs repriced to reflect that yield. All these assets have to have competitive yields with each other, and they do. And then the correction happened, the yields came back in, REITs started to recover. And basically by the time the REIT market was starting to recover was when the private market finally said, well, gee, something really did happen and we'll need to reprice and yields will have to go up and so on. And then they come back together and they move along for a while and then something else happens. If you were to look at this by property type today, there's very wide spreads in some of the properties, retail in particular. The implied cap rates for malls, for shopping centers are 400 to 500 basis points today above what they are for properties in the NCREIF universe. Much smaller spreads, obviously, for apartment and office, and then industrial is pretty much right on top of each other. In other words, both markets are pricing them the same. So if you look back over the several cycles that we have data for, Calvin's right, the public market moves first. The private market eventually sees that, eventually starts to do something. And if you had to pick a number, they sort of meet in the middle somewhere. And I would expect that'll happen again this time as well.
Well, that's a little bit evident in the next slide, I think. Is that slide 24?
24, yes. So this is something we just put out a week or two ago. Russ Devlin and our team wrote a little paper. Just looking back at prior periods of drawdowns in the REIT market, share price drawdowns in U.S. equity REITs. And the table to the right is really the important part. This is what I was saying earlier about there are going to be opportunities. There are opportunities already for each of these drawdown periods that are shown here in the red. What we then did is went and looked at what happened over the next 3 years. And very typically, as you would expect, periods of very large price decline are typically followed by periods of very outsized performance. And the minus 40% here on the chart, I believe that was March 23rd. I think Calvin can correct me if I'm wrong, but I think the REIT market's already back up 20 to 25% since that. So not all the way back, but certainly has regained some of that. Now, is that the end of it? Who knows? But these periods of sharp decline, whether it's in private market or public market, do create very interesting entry points for investors.
Great, thank you. And Calvin, if we can go to slide 18, you've been looking at the stock market performance of healthcare REITs versus others. Could you maybe comment on what's going on in terms of the REIT performance?
Sure, I'm going to comment on that. You can see in the green box, I've highlighted what's gone on with the healthcare REITs. But first, I just have one quick follow-up to what Mike was talking about, the public market leading the private market. And this is why I describe it as a signal, not a forecast. Remember, don't lose track that in 2013, when the Fed had signaled that they were going to begin raising interest rates or removing their extraordinary policies, the public market fell an awful lot. And all of the discussion from the middle of 2013 into 2014 was the public market is forecasting that the private market is going to fall. No, that didn't happen. No, that didn't happen. There was a risk premium, there was uncertainty, but it certainly is not a reliable forecast. Now, I do expect we're going to have some weakness here, but maybe not the weakness that we saw in the prices a few weeks ago. The healthcare REITs, now let me just describe what this shows. We've got all of the different REIT sectors, and then the columns to the right show the weekly performance, and the far right is the year to date. The first point is you look at the weekly performance numbers, not just the healthcare REITs, but all of these other sectors, and actually the The Russell 1000 at the bottom, they're double-digit up or down week to week, and some of these sectors are 30 or 40% up to down week to week. That's a 3-year return in 5 days, a 3-year return in 5 days. That's the magnitude of uncertainty of where we're headed. And we have not resolved that uncertainty yet, so I do not expect this volatility to decrease. The second point is if you look at the far right column, which is the year to date, you can see that the healthcare REITs as of last Friday had a total return of minus 31%, which is really awful. It's reflecting a lot of trouble that the industry could face. That's about twice what the overall REIT sector is, and 2 to 3 times what the Russell 1000 is. And that's reflecting a number of things. One, occupancy rates are going to be lower. Move-ins are already showing some weakness. They're also going to have higher expenses, higher costs, because they're going to have to deal with the health issues. That's clearly going to weigh on them. One final contrast, you look and see some of the other REIT sectors, though, have even had bigger declines year to date. The retail is down almost 50%. The mortgage REITs at the bottom are down almost 50%. So this is a crisis that is affecting all of the sectors.
Great, thank you. If we can go back to slide 2, I'm going to switch now a little bit over to seniors housing and skilled nursing. Starting with you, Mary, what's your organization's view on seniors housing?
We've been investors in this sector in the US since the early 2000s, as I mentioned earlier. And over time, we have both, we've never invested in the skilled nursing part of it, but we have been investors in operating properties, typically assisted living and memory care. More recently, in an environment in which the yields have compressed strongly for this sector, we've been more interested in developing it rather than buying it. And we have been developing the sector in Europe, both in the UK and continental Europe, where the supply-demand relationship is a lot more attractive than in the US. The US, as everybody on the phone call well knows, has seen a great deal of supply on the anticipation of the aging of baby boomers. Many of us are not ready for seniors housing, but the stock has been expanded rapidly there. We are also lenders in this sector within the US. That's been the most active part of our US strategy in recent years. But prior to the pandemic, we were developing a term sheet for senior housing development in a supply constrained location in the United States. And I would expect that we'll proceed with that likely at a repriced basis.
Great, thank you. Mike, AEW has done investing in seniors housing for a long time. Tell us a little bit about AEW's view on seniors housing going forward.
Sure. I don't think our long-term view of it's changed at all. I think the demographic story is still extremely favorable. It's very easy to understand. It's very easy to underwrite. In the near term, of course, there's going to be a little bit of bumpiness, I would think. Much like Calvin mentioned, I think Mary touched on it as well. Certainly, lease up is going to be slower. So to the extent that you have any projects in development, I think you're going to have to plan for an elongated lease up cycle. Occupancy is going to be under pressure again for until this public health situation is solved. You're going to have fewer move-ins, so you're going to slowly have your occupancy drop down. Things we saw back in the financial crisis may come into play. More difficulty for seniors to sell their home and then use those funds to pay for their residency. Possibly adult children being under financial pressure, either because they've lost their job or some other event related to what the economy is going through right now. So we're planning for all of that, but big picture, we very much like the sector, much like Heitman. We don't do anything in the skilled nursing area. It's all independent living, assisted living, memory care, and in general, we like having the continuum of all three at the property and working with strong joint venture partners.
Mike, do you expect the risk premium for investing in seniors housing to increase, decrease, stay the same? And how does it compare today compared to, let's say, multifamily?
I don't really think so. I mean, I think what's going to come out of this as we get through the other side of this, I think I think a lot of people are going to come to the awareness that true seniors housing has performed remarkably well through a very challenging public health crisis. There's a lot of headlines every day about really bad things that have been happening, particularly in nursing homes. But it's not happening in the types of properties, not anywhere near the same extent in the type of properties that we're invested in. I think I talked to the team yesterday. As of yesterday, we had 35 cases out of about 5,000 residents. So in a very, very low infection rate. We had about 25 staff members, I believe, at all of our properties who had tested positive. So, you know, there's a lot of headlines out there that are making people anxious and nervous. But I think the industry, the sector as a whole, is demonstrating that this is actually a remarkably safe place for your parents to be, your elderly relatives to be, and you really have to differentiate between this and some other parts of the sector that are having sort of worse outcomes.
Okay, and you know, in the last time that we had the recession with seniors housing, NIC has tracked some of the impact there, and we did see that the sector was resilient to the recession. So we did see a drop in occupancy rates, but unlike the other property types, we didn't actually see any kind of decline in asking rates. So time will tell whether that's going to still happen, but that's helpful. Thank you for your comments. Calvin, what about your view on healthcare REITs and where they're going and what's going on there?
I would actually just agree with what the other two said about the overall outlook for the sector. The biggest risk is that this is in the middle of a demographic transition, and the high level of supply was really counting on a rising wave of older Americans moving into the seniors housing. And the biggest risk right now is that will be delayed or maybe won't even happen. And this is different from some of the other sectors, because if you look at something like office, you did not have a whole lot of construction of office. So even if you have smaller lease ups or things like that, there's only so much cushion that they need to absorb from the extra supply. The seniors housing has to be able to absorb a fair amount of cushion. So that gives them some work to do with this crisis. What I've seen in the immediate front right now, the healthcare REITs are doing a number of things. First and foremost, they're trying to reassure the safety of the people who are in their facilities. And that's important for anyone here. And I can look at this two ways. One is an economist and an analyst, but the other is that my mother is 97 years old and she lives in a senior housing facility, CCRC, outside of Pittsburgh. And they had 2 COVID cases in their facility about 3 weeks ago. And they put them in isolation. They send daily updates about the status, and they have done everything they can in terms of preventing the transmission in the facility and communicating. And those are really important. And I see that with the senior housing REITs as well. They're trying to ensure the safety. They're trying to make sure that materials, resources, PPE, testing equipment is available for the operators. And they are also trying to communicate on their websites so that the general public and the operators know where the resources are to find out how we're going to deal with this going forward. Those are hopeful signs that at least we're addressing this full on.
Great, thanks for that. So Mike, in regard to investment committee for seniors housing, how are underwriting assumptions changing in terms of lease up patterns or rent growth or sort of the nuts and bolts of underwriting? And have you even had that discussion yet within the organization?
Well, I mean, we really haven't. It's a great question. We had some transactions in process when this sort of all started back in February and into March, and those did progress through and are being completed. But we haven't, as of yet, we haven't had a new investment underwriting since this all started. But as I said before, I think the main assumption is going to be a much slower lease-up period if it's a development project. Maybe lower for some period of time, some lower stabilized occupancy rate. In terms of rent, it's really, that is going to be really much more a function of new supply, competitive new supply in the area. Much like Calvin said, projects that were started assuming a certain level of absorption that may be elongated now, or just take a lot longer. So probably we'd probably be expecting rent growth to be somewhat slower than we had been before. But do keep in mind this is a property type that has a very specific need. When parents and older relatives need to be someplace safe, people are still going to go do this. My mother was in an assisted living property in outside of Boston. She unfortunately passed away a couple of years ago, but she moved there at 87 when she just couldn't be alone anymore. And a lot of families are going to experience that. Baby boom's going to age. You can't slow that down. So right now, I think it's too early to make any broad claims about how underwriting is going to change.
Okay, great. Okay, I want to be mindful of time and leave time for questions at the end. So, Mary, starting with you, sort of a summary comment, if you can, regarding downside risk or upside risk, and it can relate to either the senior housing specifically or macroeconomy or capital markets and debt.
That's fabulous. I'm going to stay on seniors housing for a second and just say what we've observed in the specialty realm is the cap rates for these properties have the spread to the traditional property types have narrowed over the years. When we were first buying in the seniors realm, the spread was, let's call it 250 basis points to traditional apartments. Similar dynamic for student housing. That has shrunk over the years. I expect there's going to be an expansion of it. Anyone on this call knows just how complicated this sector is from an operations perspective. And many of you have figured out how to do that really well. So I share the positive comments that were made. My mom was a resident of a Belmont Village, about 8 minutes drive from my house. I benefited from the fine care that she was given, as did she. But it is a challenging business where you have to get a lot of things right. And I don't think that's been fully reflected in how the sector has been priced. So I anticipate that there will be an expansion of cap rates in this sector on a relative basis in the near term. Long term, the demand is extremely strong across the globe. I'm not sure we figured out how to deliver senior housing across the globe, but the demand is strong. And this pandemic is not going to change that meaningfully. So I stay positive on this sector, but I anticipate some near-term repricing.
Great, thank you. Mike, if you had to summarize a comment on either the economy, capital market trends, or seniors housing, upside or downside, what would be a concluding comment?
Well, I mean, the upside I think is pretty obvious. The public health system gets this under control quickly in a way that gives people confidence, whether that's a vaccine, whether that's widespread testing, whether that's tracking, or some combination thereof. That would probably be the best case. I think that's pretty obvious. Downsides, there's a whole host of them. I would say the biggest downside risk right now is that something else happens while all of this is going on. It doesn't seem like the policymakers have much bandwidth right now to deal with much of anything else. And if something else flared up around the world, and we could sit here all afternoon spinning out things that could flare up. But there's a lot of countries that are very much being stressed today. Most obvious, of course, are the energy producers, Russia and Saudi Arabia in particular. They're hemorrhaging cash, and they need that money to keep their populations happy. So if something else really big came onto the scene, I mean, we don't even know right now if the leader of North Korea is even alive, just as an example. So that's what I'm most worried about, that something else that requires an awful lot of bandwidth comes on the scene in an environment where there really just doesn't seem to be much in Washington right now.
Great, okay, and Calvin, same question?
Sure, I'd give 3 points. One is just going back to the public health issues, and the experts have warned us that there likely will be flare-ups. We should expect them, and there's a lot of concern that if we resume too much social activity too quickly, we'll accelerate those flare-ups, and then all of a sudden we're back at square one, and that is a real risk. That's moderated a bit by the potential that sometime next year we will have better treatment, testing systems will be in place, and we'll have a vaccine. So that's mostly a downside risk. The second downside risk is the longer this goes on, and if we have another flare-up that is severe, then what I would call the third round macro wave of effects of consumer bankruptcies, permanent job losses instead of layoffs, business bankruptcies, just drag us into a very deep overall recession that may last. The effects of it may last, beyond even when the healthcare issues are under control. I would say that's not a huge risk right now, but clearly this is just a major macroeconomic event. The third point, though, is a bit more favorable, and that's prior to this crisis hitting, most of the economy did not have the types of imbalances that have been associated with recessions in the past. Yes, it had gone on for 11 years. Yes, I know that. But also, every recession of the past 70 years, and I've studied these very carefully at the Federal Reserve and on Wall Street before I came to NAREIT, every recession has had three types of imbalances. One is overconstruction or overbuilding of cyclical types of things like business investment. We have not had that. Seniors housing has had a high level of construction relative to history, but it has the demand. Most other sectors of the economy are not overbuilt. That means that we're not at risk of a sudden stall the way we would otherwise. Not overbuilt. The other is not overheated. A lot of recessions happen when the Fed has to cool an overheated economy. The third is not over-leveraged. There is concern about rising levels of debt, but you compare the levels of debt for most sectors now to where they were 12 years ago, 15, 20 years ago. You have a lot of sectors with some strong balance sheets, especially the banking system, many of the corporate sectors. So that means that the economy does still have a stable ground once it starts to grow again. So I've got two negative and one positive.
Great, thank you. Now, if everybody will come back up to webcam so we can see you, we're going to do a quick lightning round. So Mary, Mike, and Cal. Okay, great. So I'm going to ask you a quick question and just give us a quick response to it. So just this morning, the Department of Labor reported another 4.4 million people on unemployment insurance claims, 26 million people in the last 5 weeks. How bad is it going to get, Mike?
I think we've got a couple more weeks at least of elevated claims. The anecdotal evidence is that people are having a terrible time being able to get through to even process a claim. Websites are crashing, phone systems are jammed, people don't want to go to unemployment offices. So I would guess a couple more weeks of 3-4 million claims.
It's a good time to be a COBOL programmer though, right? You can go back into these offices and really help out. Mary, what do you think, how bad is it going to get?
Oh, I'm with Mike. We've got weeks ahead of challenges, and the resumption, looking out at what China is trying to do, high-speed rail is up and running again, so are hotels, but what I'm hearing is occupancy is only 30%. So there's the hush and reluctant consumption part of this, and the US is driven by consumption. So we're gonna see lingering effects as I can't wait to get out of my basement, but there are gonna be places I won't go yet for a while.
Okay, Calvin, same question.
Clearly, this is just a terrible unemployment claims number, and 4.4 million is a huge number of job losses. I have a lot of empathy, a lot of concern for these families. I think we all have concern for these families. On the other hand, it's down 36% from the level of claims 4 weeks ago. It's down 2.4 million from what it was 4 weeks ago. One thing I had wondered from the beginning was whether the claims and the job market impact would be front-loaded, that there's certain types of businesses, the restaurants, the shops, the hotels, the airlines that shut down completely. And once they shut down, there's no more jobs to lose. The others will have job losses, but not that much of a magnitude. I would not say it's good news that we've seen the claims drop 36%. I would say the news is less bad. I would say we're not looking at the worst case scenarios that we saw 4 weeks ago. That's one reason why we can take off some of the real concern that the stock market saw 4 weeks ago.
Hey, Beth, one last thing on this. It's the continuing claim number that's going to be the really critical one going forward, because it'll be telling us whether or not the PPP and the other programs are actually working or not to get people off unemployment. And if that doesn't go down, you should start getting pretty worried.
And continuing claims, I think, are at 16 million.
Yeah, still going straight up.
4 million from last week, I think. So
yeah.
All right, one last lightning round, and then we'll open it up to the audience for questions. Core plus returns. So a lot of seniors housing on the private equity side is viewed as core plus. So pre and post COVID-19 in 1 year from now, Mike.
Well, I mean, if you look at the PRIA survey that came out back, before this, and then the interim one, Clearly, the consensus was for weaker returns in the near term. I think that makes sense, right? There's gonna be write-downs somewhere on something. Hasn't been much yet. Something lower over the next year, and then hopefully a bounce back the year after.
Okay, Mary?
We wrote down our portfolio in a meaningful way already, knowing that we didn't know what an appropriate discount rate was and an appropriate cap rate was, but that it wasn't what we had in place. So we took a whack, and that took Core Plus returns down 3 or 4%.
Okay, great. And Calvin, any thoughts?
You know, I don't forecast the returns in that way, but what Mike and Mary both said sounds very reasonable to me, and I would be right in their ballpark there.
Okay. All right, Chuck, I'm sure there's a lot of questions that our audience has been asking. Can you share a few of those and direct them to the appropriate person?
Certainly, and these are going to be broader market questions. The first being related to the oil market, and the drop price of oil seems like yet a further blow to the economy. Anyone have a view in terms of the implications for the oil industry and bankruptcies, and frankly, the impacts on the broader economy?
Sure, I can take that. Clearly, it's negative for the oil industry. We're going to see credit issues. We're going to see losses in the oil industry. I've seen a lot of headlines saying, what is this negative oil price? This doesn't make any sense. This is a real anomaly. You were looking at a forward market trading for a contract that was expiring, and whoever had that position the next day would have to take physical delivery. And it was very light trading in that contract that went to the negative $37 a barrel. Very light trading at the last minute. And it's kind of like if you're at a rock concert at a stadium and someone is outside selling t-shirts, and normally they sell them for $15, and the concert's over, people are heading home, and someone's saying, listen, I'll give these away to you for free. That's what's happening. There was one box left over, someone's giving it to you away for free. Now, oil prices are low, demand is low, there's a lot of production. That's going to weigh on that sector. That's not really going to hurt the rest of the economy.
Any other perspectives on that one?
Just a quick comment that the fossil fuel industry, in this Earth Week, let's just say, let's use this crisis as a chance to lessen our dependence on things that are making the Earth sick.
That's big picture. Thank you, Mary. Another question related to the construction market, and looking back at the previous recessions, can anyone give outlook in terms of the effect on forward construction pricing, materials, and labor?
Right now, there's an awful lot of cities across the United States that have moratoriums on construction, except for things like hospitals and schools and things like that. So there's a lot of capacity. We went very quickly from a situation where there was almost no labor availability to a situation where there's a lot of labor availability. Material costs are going to be very variable. It depends on to the extent that the supply chain for that material has been disrupted. If it hasn't been, the price of it is probably coming down because there's going to be excesses of it. If that supply chain has been interrupted, you're both going to have time delays, but also probably higher costs for that material. So I would have to think we'll have fewer construction projects this year and next year than we would have had otherwise. That's all to the good, I think, for existing properties and existing investments.
Thank you.
I'll just chime in quickly. I would agree with Mike that about that outlook. Keep in mind, and you touched on this, that prior to this crisis, one of the biggest issues in construction was lack of labor and shortages of materials. And so right now you've got excess labor because the demand has just dropped out. The question is going to be next year when we start up again, have some of the potential workers left the country, retired, gone to other industries? Is this going to make the lack of labor even more of a problem as we start going forward? And again, like Mike said, that means that there's going to be less new supply that's competing with the existing property owners.
Okay, so I just want to make sure that our listeners know that there's a full slide deck that you can access on the webinar right now today. You can see where you can download the PDF of it. There are a lot of slides that we didn't get into because of time constraints, but there's a lot of really rich and robust information by each of the panelists. So please take a look at that and let us know if you have any questions. And just about to wrap up, we do want to say that, NIC continues to be really concerned about the frontline care workers in seniors housing and in the skilled nursing areas, and we're doing everything we can to try to promote the idea of more testing and more PPE for all of you. And we thank you for all the work that you're doing, and take care of those residents because they deserve it. Chuck, anybody else have any comment?
Just want to thank you for letting us speak today. And my sister's an ER nurse, and I know exactly what you're talking about. It's those frontline people they're the heroes.
One of the things I meant to say in talking about what will look like a year from now is we'll have enough PPE in the right places for people, and senior facilities will get their due in recognizing they haven't had the equipment needed in this time of crisis.
Thank you, Mary.
Thank you for those comments. Nikki, if we can go to the final slide. We welcome you to join us for our next Leadership Huddle webinar, which will address conversations between operators, lenders, and private equity providers during a pandemic, and also will feature another panel of prominent industry leaders. That webinar is scheduled for 2 weeks from today on Thursday, May 7th at 11 a.m. Eastern Time. Between now and then, we also encourage you to register free of charge for NIC's Leadership Brain Dates to connect for critical conversations with others in the industry facing similar challenges related to COVID-19 and learn from those with knowledge to assist. The Leadership Brain Dates take place Tuesdays and Thursdays through Tuesday, May 5th. To register for these upcoming events and for ready access to a variety of pandemic-related market information, please visit the NIC COVID-19 Resource Center at nic.org. As NIC remains committed to continually improving these webinars, we very much welcome your candid feedback. You're encouraged to complete the survey you'll receive following the conclusion of this webinar. Within the next 24 to 48 hours, you'll receive an email with a link to download the presentation and view a recording of today's webinar. On behalf of NIC, Beth Mace, myself, and this morning's panelists, Michael Acton, Mary Lutgen, and Calvin Schnurr, thank you for having joined us. Please stay safe, maintain your physical distance, but stay connected. This concludes today's webinar.
Great. Thank you. Bye, everyone.